And one of the indicators that many people use is the simple one of dividing the stock market capitalization by GDP. In fact, some people just use the price, which is slightly inaccurate way of doing it. I've actually used GNI here, which I call gross national income. I want to use the national rather than domestic products and incomes because businesses do so much of their have so much of their activity and derive so many of their profits and revenues from abroad. And also I've used the private sector because I don't see quite why we should compare what a company or a corporation is doing compared with the government. And yes, we can see here that clearly we're up at levels currently only exceeded at the peak of the tech bubble. There is, however, just a slight matter of distortion in this, in that during the period between the two world wars, there were roughly 3 corporates for every 1,000 people, or 3 corporates producing tax returns for every 1,000 people in America. Starting at about 48, 49, the early years after the Second World War, that number started to increase dramatically. And we find that if we look at the chart, the population of corporations per 1,000 people in America goes from around 3.5. It climbs and climbs and climbs into the 2000s until it gets to almost 20, and then it oscillates along. And in fact, with some of the recent delistings and takeovers, it's dropped a bit. But what this is telling us perhaps is that there is much more business now being conducted under the legal form of corporation than used to be the case. And so some of this extra valuation in here is an artifact of the change in the population. Not all of it by any means. And clearly, if we look at the modern era, the last few years of this, the last 10, 15, 20 years, that feature itself is not one of such great relevance. So we are clearly towards the top of that distribution, even if we should perhaps reweight some of the back end of this platform. So in the attempt to find a less distorted, more representative measure, what we've done here is we've compared the corporate market cap with pre-tax earnings and sales in particular. This has involved a lot of digging through some dusty old tomes of statistical abstracts and the likes, because much of this data is not currently online in any useful form. We also have to have a slight declaration of uncertainty in that the market cap numbers themselves have to be derived and estimated, and so are less reliable the earlier we go on this graph. But nonetheless, once again, we can see here's the sales number. It has exceeded the previous market peak. And in fact, if we look, the last time it was here was at the height of the mania in the Jazz Age. So corporates are clearly squeezing more value out of sales today than they did back then. And they're being far more highly rewarded for being able to do so in terms of the valuation that the world puts on their stock price. This measure, however, is far less equivocal than the other one. At least in terms of sales, stock prices are elevated. But what about the returns being earned on stocks in America compared with the rest of the world? Well, here we've taken the MSCI version for America and done it against the world minus America. And again, you can see that since the crash, we've had a very nice outperformance, which has taken us back to the levels of the previous great bull market in American stocks, and in fact it's up towards levels not seen since the breakdown of Bretton Woods and the great revaluation and upheavals which took place at the end of the gold exchange standard in the late 60s, early 70s. So far this channel is just about holding, but you would have to say that unless you think something nigh on unprecedented is about to occur, we've kind of exhausted the relative outperformance that we can expect from the United States. And if we look beyond the developed market indexes with which we compared the US in the previous slide and turn instead to the emerging markets, once again relative total returns, we've had a very good long strong run since the crash, and the channel is now broken. Emerging markets have got back on some form of equilibrium, but so far that's all it is. They haven't yet managed to break out of this sideways pattern that we've been in for the last 2.5 years. This is clearly nowhere as extreme as it used to be. Here we have the best US relative valuation, which was a combination of the tech bubble in the States and the aftermath of the emerging market collapse of 97, 98, which of course saw a loosening of monetary policy, which perhaps helped to exacerbate this bubble in the first place. We had a long period of emerging market outperformance through the great commodity bubble and the first wave of enthusiasm for China. Since the crash, we've had a back reaction. Now we go sideways. So this is much more of a technical chart. It's not an extreme valuation by any means, like it was in the previous instance. But technically, we have to be slightly concerned here that the United States has lost its upward momentum and the thing is tracking sideways, and in fact is testing the lower end of that sideways range. So now if we look at the United States against a specific instance of a developed market counterpart, in this case we've taken a mix of the German and French markets, you can see an extra indication of what we've been talking about. And this chart's quite a nice one because there's no overall trend. This is a stationary distribution. For 50 years nigh on, this has been washing back and forth within quite well defined bands. In what you can see from the histogram underneath is not a bad distribution, slightly lacking in population in the middle, but nonetheless distributed relatively evenly either side of the mean. And again, you can see these nice waves of alternating enthusiasm and revulsion for the one side of the Atlantic over the other. At this point here, it's tech bubble time. Here's the move afterwards, which of course is partly driven in this common currency delineated picture by movements in the euro against the US dollar as much as in the underlying equities. Since the crash, we've had a strong move this way, and in fact quite a nice little swing pattern. We've got to the sorts of peaks we saw in the mid-80s, that we saw in the early 70s, that we saw in the tech bubble. Here we go, there, and here, and we've retraced. And again, we're threatening a channel. We haven't yet broken down, but there's a good possibility here of a mean reversion. Now, what would that mean reversion mean? If we go all the way back to here, which is where we were in the middle of 2014, we would see something like a 20% relative shift in favor of the continental Europeans. Now, turning away from international comparisons as a reason to introduce a note of caution on US stocks, let's look at the domestic situation. And among the fundamentals that are most frequently cited, we have the idea, the concept that is represented in this graph, namely that corporates have been induced by this long period of recovery and these incredibly low interest rates to once again make the mistake of over-leveraging. Here we have the picture for manufacturing corporations, net debt to EBITDA, and you can see that over here we're at gross debt levels and even net debt levels that we haven't seen in the modern era. In fact, we haven't seen at all. There is, of course, an underlying upward trend in this as interest rates have undergone their secular decline and corporate financial officers have become more and more comfortable with the idea of debt as opposed to equity in the structure, as the whole business has switched from paying out dividends to engaging in stock buybacks and so on and so forth. All these well-rehearsed arguments. There is a secular upwards trend, so if we detrend this, it's not quite as extreme as it looks, but nonetheless things are there poised to be vulnerable should interest rates ever normalize again. One small observation to finish on this one is that these peaks, of course, are peaks which occur when earnings collapse. So they're actually not leading indicators as such. We've already had the 90s breakdown here, the credit crunch after the S&L crisis and the other high interest rate problems here. This is after the tech bust and 9/11. This is after Lehman. And this is after the shale bust. So this is not a leading indicator, but it is a sign that there are underlying vulnerabilities. Now here you can see this idea of detrending the increase in debt. What I've done here is taken overall corporate debt and I've put it against the total volume of spending that takes place in the economy, rather than the EBITDA for the individual corporations that we're looking at. And this time you can see that the detrending is quite apparent, that the growth of debt versus expenditure has actually been on a downward track. Here are the spikes you saw in the other one, but now they've been skewed and tilted because of that underlying trend. So what we now need to look at is the change in this deviation, this divergence. And now we can see that there are periods when after 2 to 3 years, when we go 1 sigma up against this trend, this is a period when the stock market tends to struggle. And guess what? We're sort of there. So it is possible that if debt growth continues to accelerate vis-a-vis the underlying churn of dollars, of revenue, of turnover in the economy, that we will be getting into areas where in the past this has signaled trouble. Now, one of the reasons that the increase in indebtedness has been so negligible, that the effects have been so attenuated, is of course that it's corresponded with interest rates falling. So the outlay, the debt service, has gone down even as the debt has gone up. Now this chart tries to put those two together. It takes what we did before, which was the change in business debt related to the overall flow of dollars in the economy, times the market interest rate. So it's how much of that flow is now being diverted to service and paid for debt. And here we can see there's an indicator that when we get above the level indicated by my serrated line, my arrow, this is when we tend to have problems in the economy. All of these periods are periods of weakness, hidden recession, or outright recession. Now we are somewhere away from it here at the moment, but again, if interest rates rise, if debt rises relative to underlying economic turnover, then we can expect to be in trouble. So this one is not yet signaling anything other than amber, but it's heading in the direction of a place which in the past has meant trouble. Now, if there's been one truism of the past several years of investing, it's been the idea that equities aren't as expensive as they look because bonds are more expensive than they look. But the central bank's aggressive actions to suppress bond yields across the world have made equity valuations less extreme than they appear simply by comparison. Through several factors, whether it's the idea that we are in a desperate seek for a yield from somewhere, so we buy stocks for dividends when the alternative is a zero or negative earning fixed income asset, or whether it's because we're applying different discount factors to our earnings projections. However you want to look at this, it's obvious that the inflationary impact of central bank policy acting via the bond market has spread into the equity market, and that's not before we even consider things like the Swiss and the Japanese and, let's face it, who knows who else, actually buying stocks and ETFs themselves. But again, we have a slight change in behavior here because the relative move upwards in bond yields and the continued increase in stock prices, and therefore the continuing move down in stock yields, has taken us to a point where, for the first time in 10 years, for the first time since the previous market peak, stocks are no longer demonstrably cheap to bonds. Here we've compared it with investment grade corporates. Now, we must be very clear here. We are not saying we are anywhere near extremes. This could run on an awfully long way. But what we have done is remove the discount, whereby stocks were demonstrably cheap to bonds. I mean, look, here's a 35 year period of relative return. Bonds were very expensive, stocks were very cheap, and we've moved back to neutral levels. And in fact, as I say, we've put in a minor high. The cushion is eroding. It doesn't mean to say that any upward movement in bond yields from here immediately impacts on stock performance, but the free ride is over. Now, it's also the case that this same behavior can be observed in the relation between equity and high yield bonds. And don't forget that high yield bonds junk is much more closely related to equity. It's more of an equity type instrument because of the risk, because of the place in the capital structure, and so on and so forth. And again, you can see in this chart that after the crash, equities were cheap. Equities have rallied against junk, even though junk itself has been very strong and has now neutralized. So again, well away from extremes. There's plenty of scope for this to run on, but we are not now reducing a notable discount. We will be starting to establish a premium if this continues. And in fact, if we look at this chart and kind of chop off the madness at the top of the tech bubble and put the bands in here, we're probably above the middle of a normal period of behavior. So once again, less sea room, less ability for equities to ignore what's going on in other asset markets. And this might look a little tangential to the basic argument that we're developing here, but if we look at the relative returns of junk against the investment grade corporates, you don't get any more extreme than where we are at the moment. This is right at the top of the trend, right off the charts, and has also come off what is one of the better runs. The rebound obviously from the crash was the best performance they had, but we've put in otherwise the next best thing in 25 years. Junk is very expensive however you look at it. I mean, clearly the obvious chart to do is the spread term chart, but just look at the relative returns. Similarly, we seem to have exhausted the possibilities for lower grade credit to outperform the better stuff, and lower grade credit is very highly correlated with the stock market. And just to show this is something of a universal phenomenon, you remember those German markets which we said were pretty fairly attractively priced in terms of the return characteristics versus the United States. Well, let's now compare the DAX, the German stock market, with the REX, which is the German bond performance market. Again, this is a nice long chart. We have 50 years of data in here. Again, it's one that's a nice stable distribution, no underlying trends of any significance. And look what's happened here again. Since the market crash, stocks have outperformed bonds with various wobbles for the problems in the European Union. Here's the European Union crisis. Here, of course, is the Lehman crash itself. Here's the European Union crisis. Here's the wobble we had in general stock markets last year. And now look, we've made a new high. The trend is upwards. But we're within about 4% of the 2007 market peak before all the troubles started. And that would therefore put us to the most expensive level, excluding the peak of the tech telecom bubble and the madness of the Neuer Markt and all the other idiocies that went on in Germany as well as in the States. And that in turn is unprecedented until we get back to the start of the floating rate era. So again, one would suggest that although we have been to higher levels, this is not something we should rely upon happening. That even in Europe, stocks are beginning to exhaust their capacity to seriously outperform the bond market. But if bonds have possibly seen their best days, given where the central bank cycle is, and if stocks are beginning to erode their ability, to lose their ability to move independently of bonds, or at least as freely and as blithely as they have been, is there something else that we have that could provide an alternative to us? Well, ironically, of course, there are dear old commodities. Nobody loves them. Everybody's pulling out of trading them. We've switched from peak oil supply to peak oil demand in our thinking. And that has driven commodity returns to their worst level since the oil price collapse of the late 90s, which coincided, of course, with the stock market mania. And then again, we go all the way back to the period when we had essentially fixed oil prices, fixed gold prices, and therefore stocks were the only area that you could get involved in, particularly if you wanted an inflation protection asset, which at this period was becoming more critical. So we can see again that another extreme is in the process of being built, this time in terms of stock returns versus commodity returns. Now what this graph does is it essentially replicates the picture we had on the other one and lays it in light blue blocks in the background, but puts in bold red at the front the actual trend. And here you can see that we're fast approaching the third great excess in the floating rate currency era, where stocks have arguably overshot in valuation terms against commodities. Now there's a caveat here. This is a log scale, and what logs do is they stretch the bottom but they compress the top. So this doesn't look very far from here, and in the background the blue figure doesn't look all that removed from those, But because of the arithmetic of logarithms, what we really mean here is that there's probably 20% to go to match that, and there's 20% again to go to match that extreme. So this is not yet such a gimme that you have to sell all your stocks tomorrow and bundle it all into a basket of commodities. What it is saying is that they are approaching areas where in the past there has been a significant reversal of performance, and you should start to think about being prepared for it, particularly because nobody loves commodities and nobody's invested in commodities now. So to put all this in some sort of context, what we have here is 100 years of history of stocks against commodities. Now in this case we have prices, not returns, as we've been dealing with up to now. So what we have here effectively is the number of barrels of oil, barrels of gold and bushels of wheat that we exchange for a share in a productive enterprise, which of course may be using those commodities to create something hopefully of even greater value. And what we can see here is there's a almost regular, tantalizingly cyclical looking 30-year system whereby commodities become very expensive against stocks in relative terms. 1919, 1949, 1979, 2009. And what we effectively have here is a change in monetary regime which is oscillating through this. We come from, to the left of the chart before we get there, the classic gold standard. We break this down through the First World War, and then we reinstitute a lesser standard, which is the gold exchange standard. That culminates in the 29 crash, and we lurch into Great Depression, and all the monetary arrangements break down once more into chaos, and we end up in the Second World War, where money effectively doesn't mean anything because we have a command economy. After the war, we set up the Bretton Woods system, which is a dollar exchange standard, and stocks rally on forever until the excesses kick in, and in the breakdown we have the first and second oil shocks, and we abandon that architecture and end up with the free floating system. Nice little swing target there, as you can see. That culminates in the biggest stock boom in history, and then there's a slow period of breakdown which ends with the financial crash of Lehman. If you like, this period is the CPI restriction era, when the central bankers are explicitly targeting CPI, trying to drive prices down towards it. This one is the CPI expansion era, when central banks are trying to do anything they can to drive price gains up to some arbitrary CPI target. We might also call this the asset exchange era, in which the central banks will give unlimited numbers of essentially irredeemable, perpetual, zero coupon claims upon themselves in exchange for real claims in the world, bonds and in some cases even stocks, and thereby completely distort the capital markets. Now the question is, you can also see we'll follow the other side of the cycle. So we have a stock market peak in 1909, we have one in 1929, we skip, we get to 1969, we get to 99. What happens now? Are we on our way to a 2019 or a 2029 top, followed by a 2039 bottom once more, and another breakdown of the current system? Who knows? But where we are heading possibly is to this peak of stock commodity valuation at some point over the intervening few years. And for the record, if you thought that stocks were kicking commodities backside, well, bonds have done pretty much the same. And in fact, if you can see from this chart, bonds are even more extreme. Only once before, again at the breakdown of the Bretton Woods into the floating rate exchange rate era, have we seen relative returns move to these sorts of extremes. And in fact, what we have here is quite a nice technical pattern for those who are interested. So any exhaustion up here, and particularly any drop back through this previous high, then we should be chasing for a mean reversion. And just to reiterate the point, we've got the divergences mapped on the background in this time, and here we have our trend. And I can't quite draw the line straight enough here with free hand and a mouse, but you can see if I ran a ruler through those, they'd be pretty close to being where you would want as a technical trader to be selling bonds and buying commodities again. Thank you very much, ladies and gentlemen, for your kind attention. I hope you found that interesting. I hope you found it useful, and I certainly hope you found it entertaining. If you have any questions or further comments, comments, or if you'd like to see more of my work, or if you'd like to discuss how to engage my services more formally and on a more regular basis, the website address is here in the bottom right of this slide, or you can reach me by email at info@cantillon-consulting.ch. I very much look forward to hearing from you in the near future. Thank you.